Welcome to the first session on the last day of our course. Today's speaker is Mr. Milind Kothari. Milind is a managing partner of BDO India LLP, which is part of BDO Network, the fifth largest professional services network in the world. Milind is also the head of direct taxes and transfer pricing of BDO. His tax team has been consistently rating as one of the leading tax and transfer pricing firms in India by the International Tax Review. Milind has more than 30 years of experience on direct taxes and he specializes in cross-border taxation, international tax structuring and transfer pricing. He is a regular speaker on contentious international tax and transfer pricing subject and is also authored several articles and papers on the subject. He is also a member of the Direct Tax Committee of CII and an active member of CTC and BCA. Currently, Milind is very passionate about taxation and planning of intellectual property and taxation on digital economy business. Milind is also an avid follower of key management trends and his mission in life is to build a professional service institution apart from being a student of tax for life. With this brief introduction, may I introduce before you Mr. Milind Kothari. And before I request him to give his presentation, I request the President to give a memento to Mr. Milind. Mr. Milind, the floor is yours.
Very good morning to everyone. You had, I think, extensive sessions in the past few days on transfer pricing, so I'm assuming your knowledge threshold has really gone up with the help of CTC, and I consider it my privilege to be here again as a speaker, and every time I'm given an opportunity to speak before all of you all, it also gives me an opportunity to learn a new subject, and this is one more subject that I have not had the experience of handling in the past. But because of this opportunity, I've kind of tried to cover some aspect of this subject, which in a sense is relevant. It could be explosive in nature, if you may say that. There is clearly no convergence happening in terms of what happens in transfer pricing as opposed to customs. But of course, let's go through the paces of the subject and understand what it entails for us as practitioners, and also on the other side as taxpayers, what is that this subject really unfolds for us. If I may just put it that this subject has, I would say, it's a global tax implication. It is not confined only to India. Some of the tax controversies that we have seen in India in the last few years are arising out of the interpretation of the transfer pricing regulations and the rules by the tax authority, which is more India specific, if I put it. For example, the valuation of shares, the controversy surrounding that is more India specific as opposed to what you may find elsewhere in the world. In comparison to that, this particular issue of transfer pricing versus customs regulations is more or less a global phenomenon. So it's not that India is isolated in this direction. But I would also like to add over here is that globally, the world is struggling with this issue. There is no set rules over here. OECD has not got any framework of rules to prescribe for handling situations like this. So that's some of the facets of this particular situation. Again, there is not much jurisprudence on the subject, except that on both the sides of the regulations, whether it is transfer pricing or custom regulations, we find decisions which overlap into each other's domain, but it is not that some kind of convergence is happening in terms of what could be a takeaway for a transfer pricing specialist for that purpose. If you see in the last couple of years, there is a marked shift from the tangible goods to intangibles. So whereas tangibles had the initiation of starting in terms of what controversy we saw in the last, I would say probably in the first 5 or 6 years, gradually we see the shift happening more towards intangibles. BPS project that OECD started last year has probably shifted the focus completely towards the digital economy and the tax evasion that is noticed because of that. So that's some of the trends that internationally you could notice in light of what this particular subject is. So let's look at it and go into the issue specific to understand what is therein for us. I may just add one more aspect to this, is that why is it that there are more case laws in transfer pricing opposed to customs? So if you see the customs regulations and the jurisprudence on this subject, you may not find as many overlaps in terms of transfer pricing related issues. They are more confined to, how would I say, more to do with royalty, whether includable in the valuation of goods or not. That's probably the largest set of controversies in customs. And I think it rightly so, because customs being a transactional tax, unless you import the goods in India, and unless the goods have come in, and then only the transfer pricing, which is more an annual exercise at a later point of time. So customs controversies precede transfer pricing in a sense, and therefore you will find more case laws in transfer pricing on customs related issues as opposed to the other way around. So that's the nuance that we need to understand, is that transfer pricing is more, how would I say, it's some kind of a follow up on a year that's already gotten over. So except for the planning opportunities or price setting that you may want to consider beforehand, customs will always precede transfer pricing in terms of the controversy. They don't go hand in hand, in other words. So let's look at what are the major facets of transfer pricing in customs. The critical part of transfer pricing, as we all understand, is that it seeks to prevent shifting of profits by MNCs from high tax jurisdictions to low tax rate jurisdictions, essentially to minimize tax cost. As opposed to that, customs valuation, which is a process where customs authorities assign a monetary value to goods for the purpose of import. So that's the difference in both the subjects. In terms of what does transfer pricing regulations try to achieve, is that they are looking at how do you address a situation when there are imports coming from a multinational group company from which is an AE. As opposed to that, customs is purely looking at a valuation exercise to determine the value of goods that's been imported into India. Transfer pricing, as we know, is part of the Income Tax Act, and as comparison, customs is part of the 1962 Customs Act, the provisions therefore. Transfer pricing again takes care of the concept of arm's length as a price determination for all intercompany transactions. Whereas in terms of customs, the focus is more on the import from related parties. That's what is again arm's length price determination is there, fair market value. Lastly, as we know, the transfer pricing regulations in India are based on the OECD guidelines broadly, as opposed to that customs are based on the WTO agreements on customs valuation. So these are some of the key differences which you notice on both sides of the regulations, transfer pricing on one side and customs on the other hand. So let's look at and dive into the controversy per se. So if you deep dive into a situation where there's an import that happens from any, you would notice that there is an import that happened in a particular situation from, let's take an example of X Limited being a foreign related party. In terms of our understanding, it is called associated enterprise. When the import happens, the argument which, and of course the import price is taken at 100 rupees. The custom authorities would want to value this at 120 rupees, being with the contention that you've under invoiced the import from a related party. Whereas the transfer pricing authorities would want to put it that you should not have paid 100 rupees, you should have paid only 80 rupees for this particular product. So if you look at it, as the price goes up, the custom duty impact will be higher, but at the same time TP risk would be higher. As opposed to that, when the price is lower, the TP risk could get minimized to that extent, but the custom duty risk will increase proportionately. So these are some of the, if you see, there's a absolutely diametrically opposite takeaways on the side, is that what transfer pricing is trying to say is to push the prices down, as opposed to that customs want to push the prices up to garner more revenue. So there's an inherent contradiction between two regulations that come across as transfer pricing practitioners, and it's how do you find a balance in this situation? That's the key issue. That's a challenge for the taxpayer. How do you find the optimum balance between transfer pricing regulations and customs for that? So with this background of the key, how would I say, the contradiction that is set inherent in the regulation, let's go further up and see what is it that really unfolds for us. If you see, the key concern is that the price paid to the related party for a purchase transaction is too high is the contention of the transfer pricing officer. As opposed to that, the custom authorities may come around saying that the price that you're paying for the same purchase transaction is actually too low. So there are two regulators saying two different things over here. Of course, the primary objective is to maximize taxable income in transfer pricing case, which means more taxes, of course, but at the same time, that can be achieved only if you minimize the value of the goods. So the transfer pricing officer's contention would always be geared to say that you should minimize the cost of imports so that there will be more taxable income in India. But as opposed to that, the custom authorities would want to garner more customs duty, for which they would want a higher price to be paid for imports. So that would be their contention on the other side. So that is the primary objective for that. So there's one is to minimize value of goods, and the other side there's a maximization of value of good for the purpose of import. So that's the contradiction which you may discover in transfer pricing versus customs. Of course, as we know that transfer pricing is a very large landscape of transactions to look at. So we have import and export of services, tangibles, intangibles. Of course, the largest amount of controversy currently is a spate of issues that we see on the intangibles, not only in India as well as internationally. The focus is clearly shifting to intangibles as a larger domain of controversies. And the transaction coverage is also very large. As opposed to that, insofar as customs is concerned, it is restricted to the import of tangibles from related parties. So it's a small spectrum of transactions that we look at in customs. Again, we have seen, if you look at what is associated enterprises and related party tests. So the definition, of course, is there in section 92F, which has certain direct enterprises which should be covered, as well as certain deeming provisions in terms of what else could be called as associated enterprises, which is a large, again, basket of number of entities that could get covered with this particular definition. For customs, again, there are broadly three clear categories. Is that one of them directly or indirectly controls the other as the first concept. The second is both of them are directly or indirectly controlled by third persons. That's another possibility that could be there in customs. And lastly, together they directly or indirectly control a third party. So if these three relationships exist insofar as customs is concerned, then the transactions of imports are covered under this custom regulation insofar as the valuation rules will be applicable. So that's how would I say, if you look at in the transaction as well as the definition of AE, transfer pricing coverage is much larger as opposed to customs. So that's some of the differences that you notice as we go forward. Sorry? No, there is no percentage. There is only a broad definition which is in these three parts, is that if it is controlling one entity controls the other is one definition. Second is both of them are controlled by a third party, or both of them together control a third party. So that's the definition. So we do not have that kind of ingrained definition as we find in transfer pricing in customs regulations. So let's look at the valuation objective in terms of transfer pricing. Is that the test of transfer pricing is, of course, as we all know, is that purchase of goods and services need to meet with the arm's length price. That's the fulcrum of how we practice transfer pricing as per the OECD guidelines. Whereas under the customs regulations, what is determined is whether the relationship between the parties, when there are related parties, has affected the price. That's a small nuance over there, is that all that we need to justify over here is that whether the relationship has affected the price. That's the definition take away from here, from the definition that we have brought in over here in the presentation. So far as transfer pricing is concerned, as we know under section 92C2 and the proviso, second proviso, there is a deviation that is merited now plus or minus 3% between transaction value and the arm's length price is permissible. As opposed to that, in customs, there is no such range which is specified, plus or minus 3%, but it's largely left to the discretion of the appraiser or customs valuation officer to determine that despite the fact that there is a difference, whether the price variation is acceptable or not. So whereas transfer pricing is more formative in what is the tolerance range that could be seen as 3%, which is part of the regulations, there is no such deviation that is set out for the custom authorities to agree or disagree with a taxpayer or for an importer for that matter. So far as deviation from ALP is concerned, there is no hierarchy of method that could be applied. You could choose any of the methods that are specified in section 92C1, and I'm sure we are all aware of what are the methods which are there. And of course, finally what matters is which is the most appropriate method that would be applicable to your international transactions. That's clearly the important part so far as transfer pricing is concerned. As far as customs is concerned, you need to follow sequential order of elimination of the valuation methods which are given. So we'll look at the methods as we go forward from here. So there's some differences in terms of how do you relate the method of looking at your transactions. Under transfer pricing, we have 5 methods that are there. You could choose any of the method which is most appropriate, whereas custom doesn't talk about it in that order. There is a sequential process of eliminating method as we go forward from there. So let's look at it. What are the methods that we would have to deal with as we go? So the first is, of course, even in transfer pricing, we have the cup as the best method of the best choice that you could look at, comparable and controlled price. As compared to that, in the transfer pricing, in the customs regulations, you will find transaction value of identical or similar goods as a rule, which is the first choice of method to look at for the purpose of imports. Then we have resale price method, which is comparable to deductive value method under the customs regulations. Then we have a cost plus method, which is again comparable to the computed value method under the customs regulations. Profit split method, TNMM don't find a reference in the customs valuation, so you can ignore them for the purpose of today's discussion. Profit split and TNMM no bearing on this particular subject. And finally, we have other method that is now been prescribed in the section which has come in the last couple of years. And as compared to that, there's a residual method also under the customs valuation rules. So these are the methods which are available, and as I mentioned to you, so as customs are concerned, you need to start with the transaction value as a starting point. If that method doesn't apply, then you have to go to the next method. Whereas under transfer pricing, you're free to choose any of the method which are there on the statute, which being the most appropriate method. Now let's look at the procedure and compliances that are applicable. Of course, we all know transfer pricing is an annual compliance exercise, whereas in the customs, it's an import based, it's a transactional duty. So it is applicable at the time of import of goods per se. Documentation, again, I'm sure you would have digested a lot of information on this subject, is that the enterprise and transaction wise contemporaneous documentation is a requirement that the taxpayer has to come up with. As far as customs are concerned, there is no requirement which is specified by the legislation for justifying the import price insofar as import from related parties is concerned. Again, under the transfer pricing regulations, the reference could be made by the officer to a TPO if it is necessary, and generally based on monetary thresholds as we understand. Whereas in terms of imports are concerned, there's a reference to the special valuation branch, SVB, as we all understand, per import consignment. So that's the reference that could be made for bringing the valuation authorities on your subject. Audit, of course, is prescribed in the law in terms of transfer pricing. Lower threshold limit leads to an audit on year-to-year basis. Of course, that's what we all undergo every year. As opposed to that, customs, there is no audit, but of course it could be conducted on need basis. Validity of the order of the transfer pricing officer is only for 1 year as such, whereas SVB order which is made out for a particular transaction or a set of transaction is valid for 3 years. Unless manner in which import transaction occur changes materially, then that order is not applicable. Not necessarily. If the transaction prima facie does not meet with what is seen to be, if I may just go take you to the, if there is there is a relationship that is existing with a party which seem to have affected the price of imports, then the reference is made to this SVB. It's not necessarily that every import would go to SVB for that matter. Lastly, if I take you to the comparison of the penalties, of course, we are familiar with penalties under the transfer pricing regulation, which is, of course, fairly stringent, 100 to 300% on tax adjustment, 2 to 4% of the transaction value for non-maintenance of prescribed documentation, and finally, rupees 100,000 for non-furnishing of Form 3CB. These are the spate of penalties that we have in transfer pricing. As opposed to that, customs also have similarly 100 to 300% custom duty for shortfall that is there in the duty that is paid. Interest, of course, is there for non-payment of duty, which is also concomitant with the customs duty. But most importantly, in customs, you'll find confiscation of goods of import. That's a huge penal provision over here, and also it could translate into punitive action on importer as well. So it could lead to imprisonment, which you don't find it in transfer pricing. So the non-compliance from a customs perspective, which may trigger penalty provisions, are far more harsh in custom regulation as opposed to transfer pricing. So that's the key difference in terms of penalty provisions. So let's quickly look at the valuation methods which are there in transfer pricing and customs as a comparison. So let's start with the first most important, and as we discussed in the earlier slide, is that the profit split and the TNM method are not of use for this particular subject. So we need to look at the comparison, which is the first one, which is CUP as well as transaction value of identical goods. We will find the reference to CUP under Rule 10B(1)(a), and as opposed to that, under the customs valuation rules 2007, the corresponding rule is Rule 4, which deals with transaction value of identical goods. Under both the methods, the prices charged for identical goods imported at about the same time as the goods being followed. That's the similarity that you will find. And at the same time, both the rules mandate that you can make adjustments to the value of the imports in terms of the quantitative factors, commercial level factors. And if there are any significant costs and charges included in the goods being valued, even those adjustments are permissible for transfer pricing as well as for customs valuation. However, there are some differences also at the same time that we might be mindful of. And the first is product comparability, which is far more stricter under transfer pricing regulations, is that if the product is not comparable, you have to just drop and look at another set of comparables to look at. Whereas customs is more tolerant, so they've not only looked at the same product as a starting point, but they're also looking at identical or similar products. Now, these are both are defined terms in the customs valuation rules. Identical and similar goods. So they're extending the definition of what could be comparable from a strict product to two more criteria, that is identical and similar products. At the same time, if you look at it from the perspective is that how does a comparison entail under CUP method for the transfer pricing is that if there are a set of imports that have happened and there are more than one price paid for the same product, the arithmetical mean of prices is taken as a comparable if it's an uncontrolled import, uncontrolled comparable which is there. As opposed to that, under the custom regulation, if the threshold is not met with in terms of what is the value of import, then the lower of the lowest value of the transaction is to be looked at as per Rule 4.3. So it's more specific as opposed to an average that's being used in transfer pricing. So if you look at the next example on the screen, there is an import that XYZ has done of 10 kilo of raw materials from a foreign associate enterprise for a value of rupees 1,000 per kilo. And the details of comparable imports which are made at the same time are as follows. There is an import of 10 which is at 1,050, there's an import of 12, 830, 8, 905, and again 10 which is at 1,075. So the arithmetical mean is 965. So in this example, if you look at it from a transfer pricing perspective, assuming that these imports are comparable and they are comparable but uncontrolled, the officer will be happy to use 965 as a comparable, and there's a price difference of 35 rupees that you have in comparison to 1,000 that you paid. So that's the difference which is there in front of the transfer pricing officer. As far as the customs officer is concerned, he would settle at 1050 in this particular transaction, in the lower of 1050 and 1075. So that's the key difference over here, is that both the authorities look at the same set of prices of imports in different ways. While is one officer, transfer pricing, is looking at 965, the customs officer wants to look at 1050 as a comparable price. So that's the difference between the two methods that's coming out very clearly over here, the arithmetic mean and the lowest value of transactions that you may find. So that's the starting point, and I think that's largely the biggest level of comparable to look at. But of course, world is not perfect. You may not find comparable transactions which are uncontrolled. So we need to move on to the next method, which is the pricing in terms of retail price method and deductive value method. That's again a comparable between two regulations. So the retail price method is specified under Rule 10B, subclause 1, and again subclause B thereafter, whereas deductive value method is Rule 7 of Customs Valuation Rules 2007. So again, let's look at the similarity which are there, is that both of the methods take into account that start with the import price and discount it there after that with the margin that the importer has, the importing company or the SSC has taken into account, and also reduce the direct cost that he would have taken into account for the particular import, which comes to brings you to the ALP price. Whereas transfer pricing and the resale price restricts itself to that. Under the deductive value method, even for example, in the resale price method, it ignores anything to do with valuation, any processing charges that might have been added to the import. So if there is a step that has been taken into by the importer after the import has happened in terms of processing the goods, resale price fails over there. Whereas so far as deductive value method is concerned, it would still want to consider this as an expense has been incurred, and it would reduce that price to arrive at the arm's length price for the purpose of import. So there is some again difference that we notice between the retail price method and the deductive value method, and that's more how would I say, the deductive value method is more refined to that extent, whereas resale price method is a pure trading import. It doesn't want to take into account any processing charges that's embedded inside a transaction. Resale price method would not be applicable in a situation where a processing is also embedded inside a transaction. The next method, of course, is the cost plus method, which we are all very familiar with from a transfer pricing perspective. Is that it's an addition of a margin or a markup to the cost of imports of value of materials and any other charges that has been paid as part of the import. And so you can add an amount of profit or general expenses to the cost plus cost to arrive at the cost plus margin. Identically to that, a computed value method also would take into account the same, which is again the computed value method is part of Rule 8 of the customs valuation. The only difficulty that we'll notice is practically this method is not very friendly to the user. Number one is that in case of imports where you want to use in transfer pricing regulation, the foreign party or the associate party as the AE, in that situation, that could be the tested party, which is a foreign tested party, something which we are not very comfortable with. And the reason therefore is again is that when we have to justify the markup, it's all the more challenging because we have to look at foreign databases to look at similar markup. Which itself is a challenging aspect. So in a sense, the cost plus method versus computed value method for the purpose of imports is not something we are very easy to use in terms of transfer pricing, as well as computed value method, of course, is doesn't have requirement to compare it with foreign databases. So that's the differences in the two methods. Finally, the mandate of the other method is there under Rule 10 AB now, where you could use any other method for transfer pricing, and correspond to that in the customs regulations we have the residual method, which is again specified in Rule 9, and both of these methods are almost similar in principles. The general principles are same, using reasonable means. So the residual method under customs law provides that where the value of imported goods cannot be determined under the provisions of any of the specific methods which were set out before, starting with the transactional value, thereafter the deductive value, and then again the computed value. You could go back to look at the residual method, and using reasonable means consistent with the principles and general provision of these rules, and on the basis of data available, you could justify your pricing of imports under the residual method. So that's other method as well as the residual method. We don't seem to be using other method as often in the transfer pricing study, and likewise the residual method is also the method of last import, in terms of if other methods are not able to bring you a price for the purpose of determining a customs levy, then you might want to use the residual method. So that's so far the methods are concerned. So the methods are already there in both the regulations, more or less identical in some ways. Some differences are there, not to speak of, but that's how the valuation is done. But the results come out very differently under both transfer pricing as well as customs valuation rules. Is that, as we saw in that example, is that same set of facts, the transfer pricing valuation results into a different price as opposed to customs. So that's what's the key takeaway for the purpose of our discussion today. Now let's come to the heart of the situation. What is that is bothering us, which is the issues and impact. So impact on customs should be considered while setting a transfer price or changing it prospectively. That's one of the key factors that one would need to be mindful as you determine your international transactions and imports from associated enterprises. Now we also understand that there are possibilities of retroactive upward adjustments of on account of transfer pricing. So we have, when we do a certification at the end of the year, we find that the price of imports need to be adjusted because of certain criteria. Then there is an upward adjustment that has been called for at the time of certifying the transactions. This doesn't go down well with the custom authorities. Is that what it means is that you suppress the value of imports or undervalued the imports at the time when you did that, and this may result into additional customs duty which you may be asked for to pay. So any retroactive upward movement of adjustment that you make, so put it effectively speaking, is that when we certify international transaction at the end of the year in Form 3CB, and if there is an upward adjustment that you are mandating for the client to make or the taxpayer to make, also expect that you could have a parallel, nuisance coming from customs for short payment of custom duty. So that's an important aspect that we should be always looking at as we go. Likewise, if you're looking at retroactive downward adjustment to transfer prices, on the other hand, this may not be again acceptable to customs authorities, in that is that if there's an excess custom duty paid, you cannot ask for a refund of that. So if you feel that what you paid is a price which is higher than what you should have paid for in a comparable situation, you cannot go back to custom authorities and demand a refund. That's saying we paid excess duty because the value of the import was considered as higher for the purpose of determining the customs duty. So that's both these situations don't work so far as customs are concerned. The next is the ALP under tax law may result in custom valuation risk. So let's look at why that risk is there. So the first is that under the transfer pricing law, when you are conventionally looking at margin determination at the end of the year, and we end up using, let's say, T&M method or entity level margins to determine transfer pricing justification, the annualized entity level approach is not something that the custom authorities will want to accept, because what they would want to look at is, despite the fact that the margins you are able to justify under the transfer pricing, so far as customs are concerned, each transaction is as an independent transaction, and they would want to see that is there a revision of duty for each transaction. So there's a difference in how the justification happens. So necessarily, because you have arrived at an ALP price which is justifying a transfer pricing benchmark, is not enough at all for customs purposes. That customs may still want to dispute your valuation if the transaction value for a particular import is different from what is acceptable from the valuation perspective. So that's a key difference over here. Again, it may not be again transfer pricing law. It may be possible to justify a lower import price based on several criteria. So you have adjustments that are possible to be considered, such as new product launches, considering that the marketing spend is also done by the importer. These arguments are not acceptable to custom authorities. So the adjustments on account of extraneous factors apart from price is something that's not possible from a custom perspective. So that's again a very important aspect that we need to consider, is that when the transaction or the transfer price are being considered, how are you going to factor in this adjustments that you want to volunteer in terms of market entry strategies or marketing spend which is done by the India counterpart? All these factors are not something that are agreeable to the custom authorities. Again, as you would see in case of large multinationals, there are global TP policies which are always there, which are conventionally used, and you could go to a transfer pricing officer with these policies and argue your case, saying that we have global transfer pricing policies which are fairly neutral to all the associated enterprises, and therefore the prices should be accepted. Whereas under customs, they will not accept this policy as a starting point, and they might still want to argue that this policy are geared to reduce the custom duty impact. So this is again a challenge from a custom perspective. We also conventionally see many transactions in the range of royalty payments, cost contribution agreements, payment of management service fees, conventionally in intercompany transactions from AEs, along with set of imports that might happen. And we have documents, agreements for that. We justify each transaction from a transfer pricing perspective, whether there is a merit in paying royalty, whether there is a cost contribution agreements entail a service to the Indian AE, as well as management service, whether a benefit is derived by the Indian enterprise. So these are tests which are there for the transfer pricing perspective. Whereas under customs, there are specific regulations to see that if there is a royalty which is stripped off and paid separately than the price of the imports, if it is relatable to the royalty is relatable to the import, then it is clearly to be added for the purpose of custom valuation. So if you see the spate of controversies that are there in custom regulations, I would say 9 out of 10 cases would be only relatable to that, is that the SVB disputed that the royalty payments are all made for the purpose of imports of goods, and therefore they should be taken into account for the purpose of charging the custom duty. And of course the courts would have held that the royalty agreement don't actually have an association with imports. So the largest controversy in the custom landscape is more to do with royalty payments, because the customs always wanted to argue to say that the royalty is nothing but a separate consideration for the purpose of import. So that's the largest set of controversies under the custom regulations. We see it differently from a transfer pricing perspective. So we see a transaction-based approach to see what is the purpose of payment of royalty, and whether the royalty is at an arm length margin that's being rate that is being paid. So that's our perspective from a transfer pricing perspective. The perspective for transfer pricing and customs are very different for these transactions. That's the key differentiation. Again, flavor of the season, the APAs which we all talk about, 140 filed last year, 250 filed this year, some resolved. Lots of excitement that APAs will bring a big relief to the taxpayers in India from a transfer pricing controversy. APAs will resolve the transfer pricing dispute, but would do nothing for the customs pain that you might have. So despite the fact that APAs address and de-risk your transfer pricing strategy, it will have nothing to do with your custom import. So they will still want to keep that. They will not accept APA and let you go off if there's an undervaluation of goods in your case. So that's the uncertainty regarding custom valuation may still persist in your case. So that's the big difference out there. Look at double taxation as the next aspect. Is no provision for tax refunds under either laws in case adjustments are made in the other law. That's another pain area, is that because both the laws are working in contradiction to each other, and if you end up paying a higher tax in one domain, that's in transfer pricing or customs, you cannot get a set off against each other. That's a big issue out here, is that as you try to please both the authorities, it will come at your cost. There's going to be double taxation, is that you also end up paying higher income tax, you'll also end up paying higher custom duty if you want to please both the authorities. So that's the key issue out here.
As such, there is a double taxation in transfer.
Sorry?
As such, there is a double
taxation. So yes, of course, Yatin has very rightly mentioned, is that transfer pricing itself has embedded double taxation embedded inside the regulation itself, and on top of it, there's another aspect that opens up on customs. So you have multiple complexities in terms of double taxation. So may I call it that? It could be triple taxation in that case. So so that's the kind of situation that you have on double taxation. Again, hardship to the taxpayer doesn't end there. So we have different methodologies to look at. Documentation requirement for transfer pricing is quite different from what the expectation of the custom authorities would be there. The use of comparable is again a challenge. asymmetrical information availability is always a gap that is there, is that we do not get sound comparables which are uncontrolled. So that's always been a big challenge. The timing of the valuation audit is again disparate. The customs, as we discussed earlier, is that the customs valuation happens at the time of imports, whereas transfer pricing study and even the audit happens much later, maybe after 2 or 3 years. So there's a big time gap between the two situations which are there. The assessment audit provision again are very disparate. So, but you need to balance them. You have to live both the lives, put it together. And due to differences in compliance requirements under the two laws, maintenance of records increase the cost of administration to the taxpayer. So, unending amount of compliances for the taxpayer to look at under both the regulation is that if you're not got tired of looking at transfer pricing documentation and compliances, you have on top of it to look at how do you justify this, all these transactions again from a custom perspective. And that's a big challenge for the importer. And finally, there are no provisions for joint price setting and evaluation of transfer pricing between transfer pricing and customs available. So both authorities don't work together. Therefore, you cannot come up to a price which is common to both. There is no price setting that's available jointly that both will be happy with the price that you set for yourself. So there is a median price that you discover is always going to be a trial and error kind of situation. That is something that you have to live with a situation as that. Is that if you are going to be very conservative in your transfer pricing, expect that you're going to have a customs challenge over there. So if you're going to have a ALP which is going to be much lower than the price actually that you paid for, then there is a transfer pricing risk associated with that kind of a policy framework. So there is no clear answer to this particular situation. So that's the spectrum of how would I say the intensity of the issues that are there for transfer pricing and customs read together. So how do we look at achieving price certainty? That's the common question that would come up at the end of discussion, is that can we as a taxpayer look at any kind of certainty that we can mitigate risk over here? And of course, advanced pricing agreements is something that we all understand is probably alleviate ourselves from a transfer pricing risk going forward. So as I said, it's the flavor of the season. So clearly there is a possibility that we could look at APA as a starting point, and opposed to that, under the custom duty, there's an advance ruling possible as well. But would these go together and would you arrive at the same pricing? Again, the answer is no. So despite the fact that there's a certainty which is built in both the regulations, they don't work together, and therefore you may have an APA which is in your favor, APA which settles transfer pricing controversy. You still have the risk of not having a favorable advance ruling on customs. So there is a challenge that ensues on both the accounts. So all we can say is that if you have such a controversial situation, all the best, because you may not be able to match both the and how would I satisfy both the sides of the regulators. Now let's look at some of the Indian jurisprudence on the subject. So we have a spate of decisions in transfer pricing which relate to imports, and if you see the case of Panasonic India against Sadia Pharmaceuticals and Fuchs Lubricants, all of them have taken into account where the taxpayer has gone back saying we have the prices of imports have been accepted by the custom authorities, and therefore they should be also acceptable under the transfer pricing regulations. And unilaterally everywhere the tribunal has held that what is the test under transfer pricing is the arm's length price, and therefore just because you have a price that is accepted by customs is not an arm's length price so far as customs transfer pricing is concerned. So that's what these decisions have said. So in the case of Panasonic, rejected the taxpayer's reliance on the valuation done by SVB. Again in Sadia Pharmaceuticals, the taxpayer's contention that import prices were being accepted by custom authorities should be accepted was rejected. And in the case of Fuchs Lubricants, the value of raw materials imports accepted by custom authority could not be taken as arm's length price. So it's universally accepted by the tribunal is that custom authorities valuation is not something that would go down as ALP. So you're still left loose on those particular situations as far as the transfer pricing rulings are concerned. As I mentioned at the starting point is that transfer pricing succeeds the customs controversies, because the custom is a transactional duty which is paid at the time of imports, and transfer pricing gets discovered 2 or 3 years later. So you'll have more controversy in transfer pricing as opposed to custom, because if you have violated something in customs, the goods would be confiscated and there probably would have no international transaction to speak of. So that's the practical situation that unfolds over here. Let's look at some more decisions over here. So we have another decision which is Mobis India Limited versus DCIT. In this case, the tribunal held that the valuations made by custom authorities on import of raw materials for purpose of levy of custom duty cannot be considered as a comparable. The purpose of valuation by the custom authorities to determine undervaluation, which is by very its nature would not fit with the scheme of transfer pricing analysis under the Income Tax Act. So I think that's the crux of the whole situation, is that the custom authorities are concerned with undervaluation, and by its very nature does not fit with the scheme of transfer pricing, which wants to look at arm's length price. So this is one of the direct observation of the tribunal which is most relevant for us to understand the controversy between transfer pricing and customs regulations. However, interestingly, in the case of Tilda Iceland, the tribunal upheld the taxpayers' reliance on a database maintained by TIPS software for comparison of prices of basmati rice, as it consisted of information publicly available with the customs department. So the reliance placed by the taxpayer on the data which was gathered by the customs authorities was acceptable for the purpose of benchmarking in this particular case. And I am only referring to the data, I am not referring to the valuation. And lastly, there is if you flip this side in this particular case in Coastal Energy Private Limited versus ACIT, the tribunal held that the taxpayer has no locus standi to question the credibility of customs data relied upon by the TPO. Custom authority assign values to imported goods on the basis of scientifically formulated methods and is not an arbitrary exercise. So this is a reverse situation where the TPO wanted to rely on the customs authority's valuation, whereas the taxpayer was disputing this particular valuation of relying on customs authorities. And the tribunal held that no, that's not the case, because the custom authorities also have relied on the pricing on certain data which is there, so that should be used. So this contrary to the previous judgments in a sense is that in this particular situation the TPO argued against the taxpayer to say that the custom authorities price should be accepted. So it's not that there is a one size fits all kind of a situation. It's more fact specific that you might want to look at in terms of how would you look at the valuation of imports. So that's the spectrum of things on the jurisprudence on the subject. So where are we going on this particular subject globally? Is some convergence happening here or not? So the convergence is something that is increased interaction between customs and transfer pricing authorities is something many countries have initiated in their own jurisdictions. So various governments have taken and issued guidelines to resolve the customs and TP conflicts. So you have USA, Australia, Canada, Chile, France, etc. They've come up with some kind of guidelines to meet with this imbalance of two regulations to find out what should be the best offering for the taxpayer. But of course, review of TP studies, advanced pricing agreement, arrangements and TP documentation for determining custom valuation is also very relevant. So that's to say that there is a convergence happening. There is a convergence happening in terms of the documentation that you do for TP is also relevant to an extent for the custom valuation. That's the global initiative on convergence that's happening. Again, World Customs Organization and OECD conference on TP and custom valuation that was held in Brussels in 2007, followed by a focus group in October 2007, is set about addressing this particular issue of convergence. So if you look at what happens in Australia, the Australian custom authorities have published a practice statement to provide guidance to custom staff and industry stakeholders on how the valuation would be considered in the light of transfer pricing arrangements. And there are changes that are being recommended to facilitate transfer pricing arrangements to allow a refund if there is an overpayment of custom duty by reasons of a downward adjustment. So there is a bit of convergence happening in Australia, is that in case if there is a higher payment of taxes, and then you can ask for a refund from a custom perspective. So that's a possibility that's been embedded in the legislation in Australia. Again, in USA, the custom authorities have shown some willingness to, in certain circumstances, to consider a multinational importers IRS-approved APS, transfer pricing studies and other tax-related pricing practices in establishing the customs valuation of imported goods. So in USA also, you will find some conversion happening. and they are willing to entertain refund of duty if you are able to demonstrate there is a downward adjustment required for the purpose of transfer pricing. So in US and Australia there have some conversion happening, but it's not in a full scope of things, that there are regulations available that you can fall back on. Now let's come to India after this. So what's happening in India? India, there is a formation of a joint working group between the transfer pricing authorities and the customs. So there was a CBC circular dated May 8, 2007, circular number 20/2007, essentially consisting of members from both the sides. So there was a group which was co-chaired by the member of Income Tax Department as well as CBDT member, again was part of this. And essentially there's a convergence in terms of cooperation between the two departments. So there's a two-tier cooperation through recommended bi-monthly or 6-monthly joint meetings, training programs which are common for both the offices, sharing of related party information and on need-to-know basis, and exchange of information on specific cases. So this convergence that you can see in India is more specific and geared towards garnering more revenue for both the departments. It was not the case of taxpayer to say that the convergence was to benefit the taxpayer, to say that can you find a median that is acceptable to both the parties. That was not the intention. The intention for this convergence was purely for both the department to find out how they can collect more revenues. So that was a perspective in front of this particular group. So taxpayer is not in the spectrum of this convergence process. There's only two regulators trying to come together. Taxpayer is still outside the box. He has to fend for himself. So with this, my presentation on the customs part is concluded, and there are, of course, there are some extension of the presentation in terms of coverage of the applicability of transfer pricing to section 10AA. Again, something that you would have practiced practically is that the balance is again very delicate, is that there is no tax holiday available on more than ordinary profits under transfer pricing, which confirms in a sense to what the customs would want to argue. And application of ALP principle prescribed under Indian TP regulations is now also applicable to the domestic transfer pricing. And there's a fine balance required between the transfer pricing and tax holiday provisions that you would need to meet with. So it is not good enough to justify an arm's length price. Also, if you make more than ordinary profits, you have a limitation of the exemption available in that particular section. And so these are some of the issues with regard to applicability of transfer pricing to section 10AA. So that's the perspective. I think the next item is, which is again, how relevant is this transfer pricing from the purpose of, from the perspective of, is it enter the boardroom as yet or not, the transfer pricing, or is it confined to tax practitioners? So is corporate governance impacted because of the transfer pricing controversies? And we all know that transfer pricing has every year shown remarkable amount of adjustments being made to income. So we have figures which are seeming unearthly in terms of 40,000 crores, 45,000 crores in FY 11-12, which amounted to 70,000 crores in FY 12-13, again 60,000 crores in 13-14. They are big numbers, and clearly with these kind of numbers, it cannot not enter the boardroom. So effectively speaking, corporate governance, which has to protect the interests of the shareholders, can they ignore this particular aspect, that is transfer pricing? And the answer is clearly no. Effectively speaking, transfer pricing controversies have entered the boardroom and clearly impacting the corporate governance in that process. So the uncertainty that is bringing, which is already there on the table, the limited guidelines, contradictory rulings by Indian courts, all this clearly compound the matters for sound corporate governance on limiting the exposure to transfer pricing risk. As we see, significant adjustments made by the TPOs on account of share valuation, corporate guarantees, market intangibles. There are some controversies which are clearly out of the box. So if you, I'm sure you would have already seen share valuation as a controversy, and it defies logic how this kind of adjustments are being made from the perspective. There is no income, and despite that you have adjustments which are running into few thousand crores. But that's the way transfer pricing is practiced in India by the regulators, and that's where we'll have to live. And therefore, the board of directors or the corporate governance has to be mindful of these situations to understand how do you deal with that as you go forward. So these transactions that are looking at share valuation, corporate guarantees, marketing intangibles, despite the fact there are contradictory rulings, are clearly still something that is worthy of notice for corporate governance. So which are the pressure points that which are relevant from the corporate governance perspective? Clearly, the legal position and ensuring that the aligned with the Indian laws is something that is mandated. Is that if the company is taking any positions which are in controvert the legal positions that are emerging, there is a transfer pricing risk over here. So I'm not trying to canvass that necessarily there is a transfer pricing adjustment should or should not be required. The question is there a transfer pricing risk? That's, I think, is the largest part that one will need to look at. Is that it does not necessarily mean that there is a how would I say, there's a transfer pricing adjustment called for, but what is most important is to understand the transfer pricing risk, which is different in a sense. Also, the methods that are applicable for transfer pricing, and there are various methods. There are some methods which are appropriate. All these need to be understood by the board of directors or all who practice corporate governance for that matter. Ensuring documentation requirements are strictly and completely met with, and I think that's one of the largest reasons why some of the transfer pricing controversy have ensued is on account of less than adequate documentation that is being maintained by the taxpayer. So that's something, again, is a very important aspect that need to be understood. Real-time basis update of the judicial legislative developments happening in India is another factor. What was good before 3 years is not good today, as we all understand, is that new set of controversies keep surfacing. Tax department keeps discovering new set of issues that were not there existing before, say, 1 or 2 years now. Corporate guarantees, one such aspect. Marketing intangibles, we've seen controversies coming up in the last few years, which are not there in the last 10 years, if I put it that way. So the boards need to be mindful of the new controversies that are coming up, which would impact them. There is BEPS that is now being canvassed, that is going to be probably in a year's time, we'll see more action happening over there. There are 15 subjects identified, and some of these subjects would clearly impact transactions between related associate enterprises. So if you are not understanding, or as a part of the board of directors, the impact of this developments on your transfer prices or your transfer pricing risk, you're taking a big risk over here from perspective of taxes. Finally, ensuring timeliness and completeness in compliances is also very important. Transfer pricing demands significant compliance of the taxpayer in terms of documentation as well as compliances at a time of filing returns and so on and so forth. And of course, the board of directors must be aware of what are these compliance requirements. And finally, of course, the penal consequences are also fairly stringent. Again, they need to be made aware of for this purpose. And please be aware is that all the people on the board of directors are not necessarily chartered accountant and tax practitioners. So for a average director on the board of a company, he does not understand the consequences of transfer pricing as we understand as practitioners. So this communication is very important from the perspective of how do you have a sound corporate governance built inside a company, which is very important. So governing board should increasingly take responsibility of identification, quantification and management of transfer pricing risk from a corporate governance perspective. So they need to identify material intergroup transactions, especially off-balance sheet items. So it's not necessary that you have, and I think we all know is that every international transaction is not there on the financial statement. There are transactions which are off the balance sheet or off the financial statement which also are impacted. So that also something that the board of directors, the governing boards must understand and be mindful of. Ensure there is a coordination among cross functions such as operations and finance so that the pricing adjustments are appropriately documented in intercompany agreements. And you would see multinationals practice transfer pricing and the pricing of products in a very different manner. Is that there are several very large multinationals that I've had the occasion to speak with, and they've mentioned is that when they come to pricing of products, there is a first requirement, it has to be cleared by the transfer pricing team globally before the prices are set in every jurisdiction. So which are very important aspects. All those who don't understand this part of pricing clearly fall short of it and end up having controversies ensuing at a later point of time. So if the functions in a company, which is a marketing function and the sales function, do not align with the finance and tax function, you are asking for a big risk at a later point of time. So that's something boards need to the governing board need to understand very well. Also look at conducting an impact analysis of potential transfer pricing risk on periodic basis to itemize two things. One is where it leads to double taxation, which also means increase in the effective tax rate, which is always a matter of great concern for tax for multinationals. I think the whole world, if I say the multinational is driven by the effective tax rates, so they are all struggling to find out how do you globally reduce the effective tax rate. So, but if that is a focus of attention, it's equally important to understand the transfer pricing risk that you would have. So, impact analysis on periodic basis is clearly a very important aspect for the strategy purposes. Reporting and justifying transactions that do not meet with arm's length price to the board. So there has to be a mechanism that has to be built inside to discover transactions that don't meet arm's length price, which potentially bring risk to the company. So that's something that again is an important aspect. And because of TB documentation for statutory disclosures in terms of alignment with cost audit rules, Companies Act 2013, AS 18 issued by the ICI, tax audit report disclosures. So transfer pricing documentation would have an impact on all these compliances and requirements under cost audit and the financial statement certification and so on and so forth. Again, proactive approach for amendments in the legislation on introduction of the new DTC 2013. So there is no end to it. DTC 2013, BEPS and all of that. So there is a lot of homework to do for board of directors to ensure that the risk is minimized at an entity level. And of course, especially to minimize the transfer pricing risk, fall back on APS and safe harbor for better certainty is something that is always canvassed for. So these are some of the issues that should stand focus for the corporate governance and for the board of directors. So that's the spectrum of things that are now necessary. So in other words, if I may just summarize, is that transfer pricing is not something that is confined to taxpayers and tax practitioners. It is very much a relevant issue for business at large. Companies that do not take into account and cognizance of this controversy take a huge amount of risk in exposing the company to a higher effective tax rate. So these are some of the issues that they would need to be mindful of. With this, my presentation is completed. So if there are any questions on the customs part as well as any of this part of corporate governance, I'll be very happy to answer them. Thank you.
Can you throw some light on the provisions of the Companies Act 2013 relating to transfer pricing, right, in the transaction related parties,
Right.
which are otherwise not covered within the TPA provisions?
No, I think in a sense, in the transfer pricing regulations, the coverage is much wider. So it's not that Companies Act 2013 and the coverage thereof is trying to extend the scope of transaction which is there in transfer pricing. So if you start with the concept to say that what is already there as an arm's length price as related party transactions, I think you're adequately covered to look at the Companies Act 2013.
So for example, there is a sale of goods to domestic related party.
Right.
That is not covered in the domestic TP also. So whether in respect of that also compliance is required?
No, because then it goes out of the realm of transfer pricing.
Right.
For that reason. Therefore, you may not want to look at transfer pricing regulations to give you any support for your domestic transfer pricing, domestic transactions as you cover. So it's not domestic DTP transactions that are factored into.
No, but whether Companies Act requires board of directors to ensure that that is also at arm's length price, so that to comply with that they will come to us saying that you say just analyze it and whether it meets the arm's length price or not.
Yeah, so there are two different levels of test over here. Is that number one is that if there are transactions with related parties, it is to do more with the true and fairness of the accounts. So that's the first test that is there. The second test, of course, is if these transactions are also covered under transfer pricing regulations, the arm's length pricing has to be looked at. So you need to look at it to different domain, put it this way.
His perspective is that under the new Companies Act,
Right.
what has happened is all the transactions between the related parties, you have to now more or less certify that they are all at arm's length.
Quite right.
So what has happened is the current audits have already started. They literally closed their audits during the month of April, May.
Right.
And they are already asking for tax certifications from the tax guy who's doing the transfer pricing. And they are just trying to say, just don't cover these transactions, but each and every transaction. So now the concept would become a lot wider, though the income tax is not covering that.
No, I do agree. I mean, it's not that you can walk away from this situation in terms of justifying the price that is paid to domestic related parties. All the same, the tests which are there for the pricing for the related party, which are not covered for domestic transfer pricing, are very different. Not necessarily the same, if I put it that way. So, despite the fact that you as a tax advisor would be asked to give a view on the subject, whether the prices are relatable, this is clearly not a transfer pricing issue in my view. So, that's the way I would look at it. Right. Sure.
Now, can there be another view that residual value is prescribed under the custom valuation rule? Would be another method which could be accepted by the income tax?
You may take a stand like that if the other methods are not applicable, but the difficulty also would be is that if the tax officer does not agree with the method that you've used, you are back to square one. I mean, in a sense, you can go back to the other method under Rule 10A, AB, and also look at residual method under Rule 9 as far as custom valuation rules are concerned. But is that alleviating your problem? Probably my answer is still no, because it may not be the most appropriate method as a starting point under transfer pricing. So that being said, if you are not able to have a pricing discovered on any of the other methods and then you go for other method, that's a different perspective. So, but by purely going to other methods and saying this is the price I want to take into account, cannot take you away from the risk. So, officer may still want to say cup is the most appropriate method in your case, if there is a uncontrolled transaction available.
Indian company has a wholly owned subsidiary in USA, it receives dividend from its subsidiary. So to justify this kind of transaction, which method you will follow and how will it justify that it is at ALP?
In a sense, this is not a customs issue because customs really cover tangibles, but now dividend income as such, it's a difficult question in terms of how do you justify the ALP of dividend that you receive from a wholly owned subsidiary. So I think, you will have to go to the methods and justify it and then look at whether there is a method that you can apply in a situation as that.
I cannot think of any method or any methodology which can...
Yeah, I think I can't disagree with you, even I cannot think of a method. Quite right.
In that particular method, when the composite contracts are to be held, these are the composite contracts of EPC. There is no separate bifurcation. Can I say that the customs rules, so far as the offshore supply is concerned, and so far as the other services are concerned, the ITP valuation rule will apply? How the interplay between customs valuation and the EPC contracts?
Yes, I think whether you take EPC contract or a plain simplicity or import, I can't seem to think there is so much of difference there. And essentially you need to go back to the valuation rules under transfer pricing as well as under customs. Obviously under the transfer pricing we need to look at the arm's length price discovery, whether it's an EPC contract and imports under an EPC contract for offshore supplies. As far as customs is concerned, again it's a question of does it come into the transaction value method or not, number one, and if it doesn't, then can you look at the other methods that are prescribed under the valuation rules. Because of the divergence of both the regulations, the train does not meet, so they go into different directions. So unfortunately, to find a convergence on this particular price between that can be agreeable to both the parties is clearly not in the offing. The only way to really look at how do you minimize the controversy as far as a taxpayer is concerned is to look at APA as one way to resolve a problem. But of course in EPC kind of contracts, it's not something that's going to have a long fetched value for you. EPC contracts have a life in probably not 5 years. Of course, but you can look at an advance ruling for imports for that purpose to at least de-risk from a custom exposure, because and there the controversy could be very large if I put it. So I may also want to add, and refining from what you said, is that in a plain simpliciter imports, the rules of the game are a little different. Whereas it comes to EPC, there's always an allegation of services embedded inside the price. So the customers are much more keen to understand what other services are provided, whereas you try to reduce the cost of imports. In that case, I think the risk in customs is also fairly significant and large. I think probably I can't say categorically that in a blanket statement to say it's larger than the transfer pricing risk, but clearly a very large risk in EPC contract for imports. And therefore, I think one of the ways to mitigate, don't look at transfer pricing, look at customs regulations as independent regulations, and maybe go for an advanced ruling. That's what I would probably want to say. Yeah. Any other questions, sir?
You just talked about EPC contract and you may trade off between the transfer pricing and the customs. But practically, is it right to say that custom duty is a lesser peril in the sense that you get, in most of the cases, you get the credit for the customs duty for the manufacturing, whereas as far as transfer pricing, income tax is concerned, you don't get any credit.
I think there's a fair point to make, is that if you paid a larger custom duty, it gets added to cost, which is deductible. But there is no rocket science to say that you pay a higher cost and then ask for a deduction. Anyone can do that. So it's not saving money as much, because on a right. So I think he's on the
even if you accept and pay higher only in the beginning only.
Yeah, and at the same time, so if you imported a higher cost and there's no misgiving that there is an evasion of duty, in that sense, are you not able to recover the cost is the perspective. And I think fair to say that yes, it's a deductible expenditure from a computational perspective, and you can claim the duty paid as a part of the cost of imports to reduce your tax income. But that's not something that is a tax beneficial method of dealing with the situation. Also the fact that, of course, if there's a transfer pricing adjustment made in assessment and there is a tax to be paid, is not a deductible expenditure. Tax is not a deductible expenditure at the end of the day. So I think there is a give and take, but I think neither of them are really a pleasing outcome to look at. So I'm not to say that I'm more happy to see that I pay more custom duty and I've therefore saved taxes. That's not the canvas, if I may put it. But yes, I think a good observation to say that it unfolds differently. It doesn't fall the same way. Yeah. Any other questions? Yeah. So thanks for a patient hearing, and I'm privileged to be here again. Thank you.
May I request Champak Deria to propose a well-deserved vote of thanks?
Had talked of CIT giving a chance to look into the subject where he has not dealt in a lot. But the masterly convergence and the analysis presented by him on the subject of transfer pricing and customs has been an eye-opener and a great takeaway for all of us. On behalf of CTC and all of us, sir, we are very thankful to you for sparing your valuable time and the knowledge sharing that you have given to us. I request you all to carry out this vote of thanks with a loud applause. Thank you.
Now we break for tea for half an hour.